early birds, thank you so much for coming to this earliest of sessions. I think you're in for a real treat. I will remind you all, and there was something also posted, that you have access to the tutorials, to the written chapters, either if you're a member or if you're attending here. You can go online and do that. They're also softbound. If you really like to have something physical and a book you can leaf through, those are available at the exhibit booth for Informs. But you're also in for a treat because we are in the vanguard of the new technology here of being able to deliver not just written words, but also we are recording the audio here to be synced with the help of our technician here, to be synced with the slides. So very often this gives additional depth, information, intensity, and animations, as well as other things that can't be given on the printed page. And these will also be posted up on the Inform site in due course. So especially if people couldn't get up this early and you know they'd be interested, there's a wealth of information available here. I'm so pleased to have our two speakers here. John Birge has given a lot to our society in terms of managing our journals, and a lot of expertise in the financial area, comes from a mathematics background, but also decided we can use financial modeling and optimization to help firms solve their problems. He'll be talking first, and then Jimin Peng will be also part of this presentation. He has an interesting background because I see that in Holland, in the Netherlands, you were trained. You had positions in Canada and somewhere else, and then on the way to Houston. So you're sort of the traveling financial analyst. So welcome you both here, welcome our audience, and let's welcome our speakers. I'll get out of the way here. Thanks.
As Doug said, thank you all for being here at this ungodly hour of 7:30 in the morning. When I saw it on the schedule, I thought, oh, there must be a mistake. They clearly didn't really mean 7:30. But nevertheless, I want to thank you and welcome you to this session. I'm going to start off, and then Jiming will kind of follow up. It is tutorial, so it's very much about kind of the basis of thinking about systemic risk and how the structure of networks can affect systemic risk and can affect the propagation of risk that goes throughout the network. So that's kind of the overall goal of where we're going to go with this. Okay, so what I'll do is I'll start off giving you kind of the lay of the land in terms of systemic risk and where network methodologies fit into it. And then the model, I'm going to talk about the model that has sort of been the prototype for almost everything else that's been done in this area analytically, and that's this model by Eisenberger Model, which was published in Management Science, and so we'll talk about that basic clearing model, and then many of its variants, some of which I've worked on, and then we'll talk about vulnerability and resilience. And basically adding things into this model that allow you to look at different kinds of issues, like how stable the network is or how vulnerable the network might be to some kind of disruption, and how you can then mitigate risk, and what kinds of ways can you use optimization models to improve the performance or improve in terms of reducing those vulnerabilities. Okay, so that's the basic agenda. Okay, so financial networks are interesting, both from the fact that they join many institutions, many individuals, many corporations, that they join them all together across the globe. And one of the interesting things about it is why is it so densely connected, but also has some kind of sparse parts to it. So you see some things that are very, very dense, like some banks, for example, that are connected to many, many other smaller banks, whereas others might have very few connections. And so we see different, it has a different kind of structure that maybe we can learn from, or maybe we can be able to make predictions about. So based on the structure, what kinds of predictions can we make about the rest of the network? So if we think about it in terms of financial institutions, some of it comes from loans, banks lending money to other banks so that they diversify their own portfolios. And some of it comes from actually owning something, like having some equity stake in some of the individual, other individual holders. The advantage of, so that there's kind of two effects that go on. One is, the advantage is that if you're closely connected, then that could make things progress faster. If you wanted to transfer something from A to B, if you're connected to B, then that's makes it relatively easy. But at the same point, that can also lead to risk being propagated easily from one group to another. And that's the concept of systemic risk. That a single institution, if it fails, and it has connections to many of the others, that can spread throughout the network. And so these too big to fail kinds of institutions, banks that have many, many connections throughout the world, their connections, because they are so endemic, can bring down many, many others. And sometimes this can even happen when there's relatively isolated, what we might think is just an idiosyncratic shock somewhere in the network. But if that idiosyncratic shock happens to hit one of these highly connected institutions, then that idiosyncratic shock can become something that's more systemic, that becomes something that's more global. So a lot of this study is looking at when does that kind of action happen. So things like Lehman Brothers as being let's say a large, one of those large institutions, their failure, made it possible, perhaps for other kinds of failures to happen, and for risk then to be spread across the globe. I'm not going to go through the literature that's on this topic. It's pretty vast. If you look at our paper, you can look up all these references. As I said, the paper that in some sense started a lot of this modeling is this Eisenberger Model paper. That's the one that I'm going to focus on the most. And that's kind of the sort of the fundamental model from which all the others are somehow constructed. So what we'll do is we'll start with that, and so get down kind of what principles were in that model, and then you can extend it to many of these others. Okay, so as I said, the basic model is this clearing agent model from Eisenberger Model, and the idea of that is just that when everyone is owing, when all the institutions have these liabilities to many other institutions, what's the maximum amount that they can kind of sustain, that they can all clear at once. And they set that up as an optimization model. And then we'll make various kinds of extensions. So I'll go through this Rogers-Verret model, and then another one from Klassemer and Young, and then add on when there's, so this would be like, these are all with loans, and then we might have some equity stakes as well, so some cross holdings within the network, and then look at the extensions that that brings in, and then when we model defaults and with discrete variables as well. So most of the start of this is all continuous, and then we'll look at some things that might have discrete kinds of events, like default or no default. Okay, so this is kind of a diagram of what is going on in the Eisenberger model. And the basic idea of it is that each of the institutions, let's call them banks, each of the banks has a given endowment, or a given exogenous load. That we'll say that's its asset base. So alpha here corresponds to how much each of the banks owns. And then they have these liabilities. So there's amount that they owe one of the other banks. So this would be the amount that Bank J owes to Bank I. Now the total liability, for the notation that I'll use here, the total, so if I sum up all those liabilities across all the other institutions, then I get this total liability. That's the total amount, say, that I owes everybody else in the entire network. Now, if it turns out, so let's look at Bank I here. Suppose Bank I is waiting to get payments from its debtors in order to pay its creditors. So while it's waiting for those payments, suppose it doesn't get enough to pay off all of its creditors. If it can't pay off all of its creditors, then we use this principle of absolute priority that just says that the amount that they're actually going to pay out is going to be divided proportionally. So if they can't pay everything, then they'll just proportionally pay off the amount that is remaining. And that can be, that's what's called this fictitious default algorithm, but that's just basically saying that they're going to either pay off whatever they have, whatever the total asset base that they have is, or whatever it is that they owe. Okay, and we can write that down as linear programming, and so that's kind of the punchline of the Eisenberger model, is that we can find this total amount that can be paid out, which is this X value here. That's like the total amount that each of the banks is going to be able to pay out. We can find that as a solution of this linear program, where this is the diagonal matrix of all the total sum of all the liabilities minus the individual liabilities to each of the others. And then this is the fraction that they're going to be able to pay out to everyone. And that total can't exceed the number of assets that they have. And otherwise, it's 1 if they can pay everything out, and if it's less than 1, then they're defaulting on some of their obligations. Okay, so this is the basis of all this. Now, one of the things that you can think about from linear programming standpoint is, well, how much can they pay out as a function of these liabilities? So think of the value of this as being like, what's the maximum amount that this network can clear as a function of how much they have in terms of assets. Now, the amount they have in terms of assets might be going up and down. It might not be certain. So there might be some volatility in that. That means that the total amount that they pay out is going to be volatile as well. And so we can look at it as a function of how much these assets are. Well, now this is the value of this linear program is a concave function of this right-hand side variable here. So we have, it's a concave function of the liabilities, which means that the more and more, go to the next, yeah, Here's the proposition about the clearing vector is unique. At the optimal solution, either you get everything paid out, or the fraction that's paid out is the whatever it is that that their total asset base was, and you can do this individually. Now, again, think of this as a function of the alpha. What that means is if you have high volatility, this is like the total value that they can pay out. This would be like your asset base here. If you have high volatility, it's the expectation of that. From Jensen's inequality, we know the lower the volatility, the higher the value this is going to be. So lower volatility leads to higher value. In other words, volatility has an effect, not just that it's making you unsure about how much you can pay out or how much you're going to be paid. It has that effect not only on risk, but it has an effect on the value, the current value. So the value of these banks, the amount that they can clear, is actually a function of the volatility. So as volatility goes up, not only does it affect like how risky you might think things are, it also decreases the amount that things are worth. So it has kind of a dual effect. Okay, so that's the, as I said, that is the basic model that most, or a lot of the literature that we're going to talk about here, that a lot of that literature is based on. But now we can look at different kinds of extensions. So we can think about assessing the risk in the network with partial information. So that I started off and said, well, I know all of the assets of all the banks. But now I might think, well, suppose I don't know all of the information. Suppose I only have partial information about what the bank's assets are. So in other words, maybe I have a sample of the assets that each of the banks has, or maybe many of the assets are not mark to market. There might be residential or real estate, and that's not mark to market every day. So I don't know exactly what their values are. All of that makes for some partial information about how much each of these institutions might hold. So the proposal that was in this work by Elsinger is to say, okay, so if we're in a situation like that where we have partial information, what we could do is to find out, well, what's the closest liability, those liability distributions, what's the closest liability in terms of some kind of measure of distance, so something like the Kolbeck-Leibler divergence. So what's the closest liability that we might have to what we know? So given the information that we know, what's the closest liability we have, and then we can perform the same kinds of same kind of optimization, the same kinds of analyses, and we can do some kind of optimization over this distribution of what the liabilities might be.
John, I think it has to be better to mention that what estimate probability is in financial market, what you know is only the total liability and the total claims, not the element of that liability matrix. So that's what they call it. It's essentially you're dealing with some problem like a black box.
Yeah.
They have to use this intra-view optimization to estimate all the variables, the liability matrix.
Right, yeah. So what Jiming was saying is, so we don't know the individual liabilities. Well, so that's often not disclosed. That we don't know the actual obligations to each of the other firms. We might have aggregate information on the liabilities. now, another kind of extension could be about what happens how do we assign risk to the different institutions? So in other words, if I think about the banking network and I'd like to assess how much does each of the institutions in that banking network contribute to the overall risk of the network, how can I assess what that individual risk might be, what their contribution is to the overall network? And the proposal in this paper by Liu and Staum is, well, we can use the shadow prices from the Eisenberger model to be able to characterize the risk that's associated with each of the individual institutions. So that's like, if I gave them a little bit more capital, how much is that going to help the overall clearing value throughout the network? So we can use that assessment of the risk as well as this distance to the liabilities to be able to assess how much risk each of the individual institutions is bringing to the network. And then we could use that to assess, well, how much should they contribute to the overall security of the network? So for example, if I wanted to charge banks a certain amount of insurance in order to be able to protect the integrity of the network in some way, this would be something like how much insurance should each of the banks pay in order to provide that kind of protection. Okay, so we can get that again from the linear programming model. Okay, so one of the things in this later work, or again an extension by Elsinger, one of the things that they observe in later work is that much of what has been done in assessing risk in these kinds of models of systemic risk is really underestimating it, and partly because of this assumption about complete information, that if we assume that we know exactly what the liabilities are, we're going to get, again, because the more we spread out things, the lower these values start to get. We get higher values than we would otherwise. Partly this is just that concave function effect. And the other thing they said is that most of the analysis goes about having some kind of default triggers. In other words, just triggers on the basis of non-payment. Whereas there could be triggers on the basis of just of the volatility in the market. That's like that the asset values are going up and down. So the market shock could be significant, and there are a number of different costs associated with any of these events that could in turn also create additional losses. So the fact that I don't know how much, when there is a default, there's going to be some loss associated with that, and I don't actually know how much that loss is, and the fact that I don't know how much that loss is actually creates additional volatility, and that's going to lower the value as well. So there, I guess the bottom line is there are a number of different factors that lead to underestimating the overall value or the overall risk of financial contagion. Okay, so so a lot of the next things we're going to talk about are ways in which we can incorporate these losses that occur because of exposures to these other kinds of uncertainties. Okay, so here's one. Is this is the Rogerson-Ferrert model, and so in their model they say that when you're not able to pay everything off, there's going to be some loss associated with liquidating your assets. There's going to be some loss that's associated with not basically rationing across those that you have to pay back, and perhaps auditing the assets that you actually have. And so those losses are captured here by these parameters. So one would be that the basic asset that you have, either because you have to pay legal fees or because it's like a fire sale situation, everything's put on the market at once, that's going to lead to additional loss besides the fact that I'm just not going to, I can only pay the alpha I that I actually have. And there may be also collection losses. So I'm not going to be able to collect everything from my debtors as well. So there could be losses that are associated on both sides of those. So what we can do is to take these losses and then to put those in to the equation that we had previously, which was basically that the net payments cannot exceed the overall assets. This would be like the external assets of the institution. So we put that into the equation, and then we can solve a model like this. So this is a way to, you can see that there's an indicator in here. This is when there's a default situation. So when you're not able to pay everything off, then you have these additional losses. Now there are different ways that you might be able to do this. This model from Glasserman and Young, they say, well, let's think about the total liabilities, and then let's say however much you're able to pay off, which would be which would be the sum of the assets that you have in place plus whatever you're owed from the others who are in the network. If that's not able to meet your total liability, then there's a fraction that's lost. So the other one is sort of putting different fractions on the alpha here and different fractions on the total liabilities here. And this one is just putting a single fraction on the difference between that and the total liabilities. And now we can do the same sort of thing, and we can also look at like what's the ratio between what you actually end up with and what you would have started with. These are the leverage ratios of the different institutions, and this is the one from Glasserman and Young. That's kind of the basic Eisenberger estimator. Okay. All right. So we have those are in terms of institutions that are lending to other institutions. Now we also can have institutions that are owning parts of the other institutions, and that's this cross-holding model. And the model I'm going to go with is it's Elliott, Gallup, and Jackson. So it's usually called the EGJ model. It's Elliott, Gallup, and Jackson. And the idea there is that each of the institutions has some value. They own some fraction of the other institutions, and they get a certain amount in terms of payments. And again, it's a balancing model, but balancing across on the holdings of these different institutions and trying to come up with what their values are. Now, in this model, if there is what effectively is default, so if one of them isn't, one of their values goes below a certain level, so this is like an kind of an absolute trigger mechanism. So if one of their values goes below a level, say relative to a base, whatever their base might be, if one of their values goes below that level, which you could think is the result of just volatility in the market, so a result of market risk, if one of those goes below that level, then it creates an additional loss. So, for example, if their value goes down sufficiently, then they might have to sell some of their core assets. If they sell their core assets, they're going to lose because of liquidating them at kind of an inopportune time. And there's a fractional loss that's associated with that, and that's in this parameter beta. Now, the way this model is used is you think about this is in terms of we're going to try to find an equilibrium of the values where these losses might occur. And what this creates is like a cascade of firms defaulting as these values start to go down. So I can trigger the cascade by forcing this, this trigger value up. So if I push up the trigger value of where banks might default or where institutions might default, then I can create a default in one node, one institution, and then that cascades through to the other institutions. Okay, so a couple of things that they observe when analyzing this model are that the more integrated a network is, that helps to avoid the first failure. So the more connections there are in this network, the higher you have to move that first trigger level in order to get a default. However, the more connections you make, the worse it may be after that first default occurs. So now we may get more spreading of the defaults throughout the network. So either way, if the market is, or if the network is more integrated, more and more people connected to others, or people primarily connected to others, or if everybody has basically stakes in everyone else, there's not a substantial risk because it's kind of diversified throughout the entire network. However, that's a condition that we don't see. What we see is that some of these nodes that have very many connections, and then some nodes that don't have many connections at all, and that's kind of this intermediate kind of network, and those are the kinds of networks where we see contagion, and that's what we actually have. So one of the takeaways from the Elliott, Gallup, and Jackson model is that the kinds of networks that we actually observe are the kinds that actually are most susceptible to these kinds of contagions. Now, the Elliott, Gallup, and Jackson model is assumes that all the connections are exogenous. And one of the things that I've done in my own work is to look at what happens if I endogenize those connections. So I'm taking those, like the cross-holdings of institutions to other institutions, and endogenizing them by saying that each of the institutions solves some kind of optimization model. In this case, it's basically a mean variance, like Markowitz type model. So each of the institutions is solving their own mean variance model. In that mean variance model, they're assuming some return on holdings that they have in the other institutions. And they have some risk aversion parameters. They have a risk aversion parameter here, gamma, and they have some assumed returns, but they also have some kind of what I call transaction costs, which is basically the cost of doing business. So if I'm a French bank and I invest in companies in Germany, what's the cost for me in France to be investing in Germany? So all those things I can put in here. Like what's the cost of holding something in another country, another region of the world? Now, we don't actually observe these things, like what's their attitude toward risk, and what are these presumed transaction costs? Like what's the cost of doing business from one region of the world to another? But we can infer them from their own activity. So by seeing what the status of the network is and any kinds of other conditions that they have to meet, like capital requirements. So seeing what their capital requirements are and seeing what their holdings are, let's say at a single point in time, we can infer effectively what their transaction costs and risk profiles are. Okay, now doing that, we can run some kinds of counterfactuals. And the kind of counterfactual I have here is where I push up those trigger events. So I said as I start to push up the value at which a first default occurs, I'm going to trigger defaults, and those defaults will go through a sequence of different institutions, a cascade. So what I've shown here, these are using cross holdings of banks in different countries. So this is using actual data where I put in a number of European countries plus the US and Japan, just because the US and Japan are the largest other cross holding banks besides China. Chinese banks I'm not as clear about. So I just put in the US, Japanese, and European banks. And so what you see up here is the base case, the way the world is right now. And what it says is if you increase kind of the susceptibility of or the vulnerability of the network to a single threshold, the first country default would be Greece. And then if you increase a little bit more, you get a default in Greece, but that leads to a default in Portugal. And then if I push it higher, then Greece and Portugal go, and then that leads to default in Italy. And then this one says I get Greece, Italy, and Portugal, then it leads to a default in Spain. And then here's where it leads to default in France. And as I push it further and further, I'll get like France tripping, and then Japan tripping, and then Japan, and then Germany, and finally UK, and last is the US. Now, what I can do is to do some counterfactual where I say, well, suppose I make all the banks in Europe hold the capital requirement at the highest level in Europe. So the highest level of banks in Europe is 8%. And the average in Europe is actually around 6%. So if I take their average from 6% up to 8%, how does that change the structure of these defaults using this model of their optimizing relative to their own value? What happens is the banks now, if they have to hold more capital with their investments, they're going to change their investments in such a way that they still maximize their value, but their investments are going to change dramatically, and in fact, they're going to take on more risk. In particular, what it says is if I make all these banks hold very high capital, in particular, that makes Italy very vulnerable. So Italy actually would be the first of these banks to default. And it also makes Germany very vulnerable. So it has a very different kind of effect, probably a much different effect from increase in capital requirement than what a lot of regulators might think. The fact that you make people increase their capital without saying that they can't change their other investments means that they're naturally going to take on greater risks with those investments. And for banks in places like Italy and Germany, that could be very dangerous. And that could lead to a set of defaults that we would not want to experience. Okay. I think I'm going to turn it over to Ji Ming to continue. Thank you.
So, first, just thanks, John, for give a really very nice introduction to this subject. Next time, I'm going to talk about all kind of optimization mode and the vulnerability and also resilience of the financial network. Okay. How do we analyze here? First, I would like to mention here there is also some binary variants of the Eisenberger and the no model. This is very first here observed by Gay and Papadia. What they observed is actually in the cleaning process, somehow when a bank default, but it needs to go through a foreclosure process, which might be take a long time. And take, for example, Lehman Brothers here. The market value before Lehman Brothers filed bankruptcy is 350 billions. Okay, but however, 1 year after they filed bankruptcy here, the market value down to only 15 billions. Okay, so that's why I say in this cleaning process, you better assume if the bank default, then just set that to be 0 because that value might change substantially. Okay, so don't use that fraction model. Okay, that's why they say better to choose here XR should be 0 or 1. So in this case, we have really a binary optimization model. But also, when you think about here, the policy in bailout here, somehow when you want to bail out a default bank, so the decision is yes or no, or save it, right? You don't want to spend money and then the bank is still bankrupted, right? So that's why, so in this case, you also have the 0-1 model, but then you have some of the budget constraints on the total the bailout budget. Okay, so we got a mixed integer linear optimization model here. Okay. So next time I'm going to talk about here quite a few theoretical frameworks to study here the vulnerability of financial networks. The very first one is by a group of researchers from. Okay. There we go. Okay. So the first one is really a framework by a group of researchers here. Eisenberger, I don't know how to pronounce his name. Okay. And from MIT, and then we have also the model by Glassman and Young. Already John mentioned that. And then the last one is really the model we developed, and the paper is coming in management science. I don't know whether it's already accepted. Okay. So here is Eisenberger here. They introduced two measurements to assess here the stability and the resilience of the network. So what they define here is say the stability for the financial network is defined as the inverse of the expected number of defaults in the network. Okay, and then also define the resilience as the inverse of the maximum number of possible defaults. Okay, it's some discrete measurements. Okay, it's kind of I have spent quite a couple of years in this. Still haven't really completely figured out what that means. Okay, and then they assume the financial network here, all the banks they do have the same asset here and also the same total liability here. So this somehow, because they're using this discrete measurement here, so they have to make some assumption here that then they also consider here just discrete shock. They say here you have the shock is defined, let's say if you satisfy this condition here, where this alpha bar is because all the banks, they have the same asset here. So they use alpha bar, and the D is really the total liability outside the network, okay, and divided by the sort of the number of nodes in the network here. Okay. And then this is kind of it's small shock here, and if the other way around, they say it's SI is larger than something, then they call it a large shock. Okay. And based on this assumption here, what they proved is the following here: say when both the size of the shock and also the number of negative shocks are small, and then the network is more the network is more stable here, okay, and and with sort of if it's well connected, okay. So if the shock is small, but however, the network will become more vulnerable here if the shock is really significant, is large, okay. So, and they also shown here prove that say sort of the complete network is the most stable one for small shock, and what the single chain network, okay, you got a chain network here, that's the most vulnerable one. And then they also consider here sort of the resilience. So here it's I got mention here the difference between the stability and the resilience. The stability is you consider here a static, a fixed network, and you consider here that sort of market shock, and to see what's the performance of the system. Okay. The resilience, you look at here the network structure here, and to see which network it's more stable. Okay, so in this case, that they consider here, so you have sort of two networks here, and where look at here the liability matrix here, you have some relation called marginalization here. It's based on mathematical definition here. Say the one liability matrix can be expressed as the product of another liability matrix multiplied by a doubly stochastic matrix, okay, in suitable space. Okay, and then under this assumption, then they show that this one network is kind of it's more resilient than another one. Okay, let's just say if you satisfy this condition here. Okay, actually this observation I will come back to that. It's also observed by a group of researchers from Columbia here. They also compare the resilience of two systems here using similar characterization. Okay. And then in Glassman and Young paper here, they have actually two papers in this subject here. Instead of the discrete shock, where you have small and large shock, okay, and they consider here the shock is continuous here, and they look at here, say if a bank receives a shock here, and then look at here, what's the probability here some other nodes in the network will be affected by this shock, okay? So, and of course you can easily see here that depends on really how much the asset, the other banks they have here, and what's really the claim they can have, and they're supposed to get from this, single bank R when it's default, okay? Because when default, you want to get the payment from bank R, and then if you don't have enough asset, and then you will be not bankrupt too. That's sort of, so that's why they estimate this probability based on this, and this is just some formula here based on the definition of the equity and the liability and so on and so forth. Okay, and then they also observed here, say, and this condition here, then this bank J is safe, which means if you do have enough asset, okay, then you don't need to worry about it, because even the bank don't pay anything to you, and you can still survive, okay. So that's just the condition here, okay. And then it's a few years ago. It's actually we started looking at this problem, and when we consider here the basic Eisenberger and the normal model here, then one question caught our attention is somehow say we would like to know when the problem is actually kind of feasible. Okay, the things here, if the problem is the model itself is infeasible and somehow then some bank will be bankrupted, right? Mathematically speaking, it's easy to understand. And somehow we found it's kind of not that easy to categorize the infeasibility with that model, but luckily and just by chance, and we just consider what we call the relaxed model, and I simply remove this x, x shall be non-negative. I remove that constraints, and then what we proved here is for this relaxed model here, then you can show this model is feasible. It's infeasible if and only if here the summation of the asset is negative. Okay, what that means is really the total asset in the network. If it's non-negative here, then you can always, if there's a social planner who would like to interrupt strongly here, then you can really make all the bank, solvent. Otherwise, some bank will be bankrupted. Okay, so this is it's really kind of the proof is based on some Fox lemma or some graph theory sort of connectivity with the graph. Okay, it's not that straightforward. Okay, and then we also prove something like the basic Eisenberger and normal model here. So sort of say either you have to use all what you have to pay your liability, or you will just be okay. You can pay all the liability. And then John already mentioned a while ago, say the vulnerability and also the performance of the system here. Okay, and this somehow in the economic community here, they look at here the inequality, the asset or wealth inequality, something like that. Okay, and the stability here. So we come out a sort of another way saying here, say you have this asset inequality here, then when the total asset is fixed, then a large asset inequality in the system will actually reduce the stability of the system. Okay. Then actually, even after we submit our paper here, there's also a empirical study by some scholar from NYU actually that did a lot of empirical study to see this the asset inequality and its correlation with the performance of the system. So next is actually we look at here the vulnerability from a probability perspective here, and then and so far if you look at here, then in either the framework, but I better call it the MIT framework. Okay, they always assume it's just a single shock. Okay, a small or discrete shock. In the Glasper and the Young model here, they also consider only a single shock. So here we just assuming here the shock is random, full of sort of normal distribution here, and we also assuming here that all of them assuming the financial network is well balanced here, and the assets should be non-negative. This is just common sense. Okay, so we look at here given this, and we also assume the total asset is fixed. And then we look at here and develop some probability measurement to assess here and when the bank will be, will default. So we use that as some probability function here and then solve some optimization model. And what we proved here say essentially it's, and this assumption here, the network with a monopoly node here. A monopoly node is somehow, it's a bigger bank which owns whole asset, equal to the total asset, All the banks pretty much have zero assets, That's definitely it's unrealistic, but and we also did some study on this the asset here in the financial market in US. Actually, the top 5 to 8 banks, they own more than 90% of the asset. Think about it here in US, the financial market, there are over 2,700 banks. So it's fair to say, if you compare with these bigger banks, many banks that really have just almost zero or even asset. So this assumption is not realistic, but it's really not far away from what's in you know in real world. Okay, and then we show that if this is the case here, actually there's a very high probability here some bank will default in the network. It's almost close to 1. Okay, and then we also show that it's sort of if all the banks have almost the same asset here, that's the most stable case. Okay, pure theory. Okay, not realistic, but somehow tells us what's the worst case here. So we have also a deterministic proof, and this is just a probability analysis. So next we also look at here, once we identify the least stable network in terms of asset distribution here, then we'd like to see for which kind of network here there is sort of the resilience. Okay, and then we look at here, this is sort of the network here. We say a finance network is said to have sort of tri-diagonal structure here. So essentially, if you look at the matrix here, you have just say Lij, which close to the diagonal here might be non-zero, or also will be 0. Actually, you can extend this. This is somehow it's coming from our second paper when we solve some bilevel linear optimization model, try to connect with the solution we obtained, try to identify what's the network structure behind that. Actually, we can show it's somehow if the network has sort of a structure like a forest, okay, and that's the most one of the case here, and we show that so if the network is dominated by a monopoly node here, and then if this monopoly bankrupts or default here, then all other nodes in the system will be bankrupted too. Okay, that's what we typically hear in finance. They call it too big to fail. Okay, it's common sense. And then, however, we also observe that it's kind of interesting here. Say, if this is the case here, then not only the monopoly node bankrupts will cause the cascading failure in the network, but actually any other node in the system bankrupts will lead to some cascading failure in the system. Why? Simply because you have this extreme case, you have this very bad structure. Okay, so this is what we proved. And then next we consider here the sort of the resilience of two systems. Okay, I already mentioned a while ago, say that paper by a group of researchers from MIT, and then this is Caproni from Columbia University, and they also compare the stability of two systems here using the same concept here. So it's like you've got two liability matrices here. So one is measured by another one. If satisfy this relationship here, and then they use different measure here. Okay, so the MIT paper they consider using the discrete measure here, but then here in this paper they use the continuous here. They look at here. Suppose this say the solution here from the Glassman-Young model here, and look at the loss. Okay, so you can just take here the objective function itself, then you just consider that I like in our paper we don't consider the loss, but just rather the objective function itself. Okay, similar. Okay, because the other part is constant, right? So then the show here say if L1 it's measured by L2, then you will see and the loss in the system 1 is less than the loss in system 2. Okay, this is what I proved in that paper. One point here in this is what we observed here. Somehow, when you have this kind of relationship here, then you can easily show, mathematically speaking here, you won't have the same liability or the same claims. So somehow it's really mathematically it's beautiful, but it does violate some of these financial rules. Okay, so this is why we the model we proposed here and. Just the paper submitted in just last month. So we consider here sort of the bilevel optimization model here. So the sub problem here we consider here is for fixed liability matrix. You just try to solve the Eisenberger model, but at the mass level, we are trying to identify the uncertainty part here, say to identify the least stable network. Okay, but however here we require the uncertainty part here to satisfy the constraints with respect to the total liability and the total claims of the banks. This is because the total liability and the total claims are supposed to be known for all the banks. Why? Because the Federal Reserve here, they just get this from the seasonal report. They have to report to the government office and also to the board of directors, okay, but not the elements of the matrix. So, and this assumption here, and you can use sort of the duality theory in linear optimization. You can rewrite this as sort of this linear optimization problem, and this part actually here is nonlinear with the objective function, but you can show that because of these constraints, so therefore the last term you can just cancel it. Okay, so you end up with sort of a linear optimization problem here subject to some sort of non-convex quadratic constraints. Okay, so then there are all kind of optimization techniques we can use here to solve this problem. Okay, so one is like the ADM methods. Okay, you just update here the dual variable and the liability matrix here. Alternatively, to improve the objective function value here. Okay, and you can also use linear approximation to to find a search direction that can reduce the objective function value here. And we also observed that actually if there's only a single bank default, actually neither of these two algorithms works. The reason for that is if we look at here the constraints here, if say you have only a single bank default, and then you will just get here the delta, say it's the first bank default here, you got a delta L1 equals 0, and that's fixed. You cannot update the liability matrix. Okay, and then for that, then that's how we introduce some new technique here. Say if this classic optimization technique really cannot be applied, then you do need some new ideas how to move forward. Okay, so for the details, if you are interested, please send us an email, and we will send you the PDF file for our paper. So here it's some conclusion we observed in our paper here, and we combine all kind of optimization technique to solve that linear optimization problem with non-convex quadratic constraints. And then we also combine some graph theory or whatever, and to identify what the network structure. Then what we found is actually the least stable network actually has a different structure from what already observed in the literature. Okay, because the model is different. Okay, but somehow we also show that actually the least stable network and also the most stable network they do share similar characteristics. The reason for that it's not surprising because in the MIT paper they already observed, say for example, the complete network is the most stable one if the shock is small, but it will become the worst network if the shock is large. So and this is somehow we derive the same conclusion here, but then we are saying here it's really the most stable one, the least stable one. It's not the complete network, but it's another kind of network. But still they do have similar structure. Okay. And we also did some a numeric test to see what's the contagious risk in the networks with different structure here. We have the algorithm to identify what we call the least stable and the best stable network, and also the one based on the KL and divergence. So what we observe here is you can see here the contagious risk here, the indicator here, the shadow price for the dual problem. Okay, so the best case is very close to the KL divergence. That's already observed. Say that's why I say that all this most existing work actually underestimate the risk here, because what you are doing is almost analyze what the best case risk, but that never happen. That's why they even conclude here the risk is very small. So turn out actually in the worst case, and then the risk is much higher here. You see here it's close to 50 here, right? That's really much more significant, the risk in the worst case than what estimated in the literature. Okay. So next time, how much time I have? Okay, so 50 minutes. Oh, okay. So next time, I'm just going to mention a few mitigation risks here. And the first one is I already said here. It's the bailout model. So we have the full bailout model. That's easy. It's just linear optimization model, and then you have also the bailout model with a bailout budget. Okay. Like in US, the budget is already announced. It's fixed. You cannot change that. So you are considering what's the best way to save more banks. Okay. So you have to solve sort of mixed integer linear optimization model. So it's joined with some colleagues here, and then we actually look at this problem. I also mentioned a while ago, actually, we have the static binary Eisenberger model, where you don't have really any bailout budget here. In that case, actually, we develop a sort of a polynomial algorithm for it and show the problem. Actually, you can solve it in Stirling polynomial time. Okay. However, if you do have a meaningful budget here, and then you will see the problem becomes NP-hard. Okay. And then and recently we also developed a sort of a new cutting plan methods to solve it. Okay. It's more exploring the structure of the problem and just keep adding and more cut. So at each iteration I can add multiple cuts, but I never change the dimension with the problem. That makes the approach actually extremely easy to implement, and in most cases we always got the optimal solution. Okay, so right now we are just trying to see whether this new idea can be extended to generic integer linear optimization problem. And then next I'm going to talk about here the rescue consulting introduced by Rogers and Volatility. In a paper in Management Science 2013. So what they propose here is suppose there is a set of banks that default, and then somehow to see whether you can formulate a sort of a rescue consulting here consisting mainly the solvent banks. Okay, so to see whether you can help them. So in this case here, so if you join that consulting here, then you can just you don't need to worry about the liabilities, right? Between if you become a member of this sort of the consortium or coalition like that. Okay. So and of course, however, in such a process here, when you join this one, somehow there's certain fee you have to pay for it. Okay, this consortium. That's why they use this cap R. Okay, so sort of thing. And then based on this one, and then they define what is called a rescue incentive here. What they mean here is look at here what the gain they have here. Say before you join this consortium here, right? You are solvent. You don't need to worry about it. But then because some bank in the network will default, you want to get what you should get. Okay, so that you will get just a certain portion of what the other bank will pay you. So you got the difference, right? And then once you form this one, then they also compare here the right-hand side here, say, because you do have some bank, some default bank in the network, then you think about here what's the bailout, right, to save all these banks to become solvent, that's cost. Okay, and then you have also here sort of when you formulate this consulting here, there's a certain fee. Okay, so you compare this is the gain and this is the cost to make all the banks solvent in the network, and this gap they call it rescue incentive here. Okay, and then got also here to define what's the rescue ability here. So really depends on really the total asset you have here and the bailout cost and it's the sort of the cost here when you formulate the consulting here. Okay, so then based on these two numbers here, they try to identify whether a bank has an incentive to join the consortium to help default banks. Okay. So and yeah, a very recent paper by it's also from Columbia. I think Caponi is also one of the cause of this paper. And they consider different strategies here. So they start thinking about here. Say if there's a liquidation process here, and if one bank default, it will liquidate some of its asset to pay its liability here. Then define here this sort of the formula here for the liquidation here to meet its liability here. Okay, so if you do have enough, and this is somehow say once you liquidate it here, this sort of this is the total amount that you have to generate that cash, okay, to pay your liability here. And then they use the Glassman and Young model, sort of, and John mentioned at the introduction here. So we have this part here to quantify the loss in the liquidation process here, and you have some of these inequalities based on this formula here. So then you solve this problem. Okay, so this it's incorporated the liquidation and sort of the loss, and then consider here you have three different strategies here. The very first one is the public bailout. So essentially, you look at here how much money each default bank needs. Okay, you calculate that number, and that's the bailout cost here. And then you have the bail-in here. This is just another way here to clean the network here. So what they're doing here is say for the the default bank, they may have just issue some bonds, okay, and then and ask some other banks, the sovereign banks, to purchase the sort of the debts or the bonds, okay, so they can, the way to get some cash to pay their liability here. So they calculate here the total amount of this bail-in here, and of course, if the bank is in trouble here, and many other banks possibly they're not willing to purchase your bonds, right? Because they already know you are in trouble. Why need to do that, right? So as a social planner here, somehow they try to help this. Then what they can do is say, okay, I will help you. Okay, if you do this, and then I will, subsidize here. Say encourage the sovereign bank to help the banks in trouble. So they have this subsidized bail-in. Then come out here sort of the game, okay, a three-stage game framework here. The first one say they always try to say encourage the sovereign bank to purchase the debt from default banks, okay, and then each bank they can decide, they will choose say whether they will do it or not, right? If they don't do it here, and then so the social planner will face this, okay, whether you bail out or you decide to say, okay, it's too expensive, I'm going to walk away and just let the bank die, just like the very beginning, the Lehman Brothers here, the Federal just say, okay, I'm not going to save it, okay, and then let it die, okay. So that's kind of sort of the game here. And then they also study here, characterize and when actually it's optimal for the social planner here, under what conditions, which strategy is the best one, For the bank here, it's definitely the public bailout is the best one because they don't need to, spend anything, but maybe not best for the social planner. They identify certain conditions and which policy you should implement. Okay. My crew and my students actually they propose a different strategy here, and so what they're doing here is similar to the risk consulting. They try to formulate a correlation of banks such that each bank in that correlation here will pay the same fraction of the liability. Okay. And then they consider here and two incentives to initiate the cooperation here, the sort of the threat tax by the government. Okay, so it's again the social planner try to intervene the cleaning process here. They also hear the threat of credit and debt weight loss here. Okay, sort of they develop some linear optimization model and to solve that. Okay, But also very recently, actually, myself and Aein, we proposed a new model here. So what we're thinking is look at here, that's the risk consulting here. So essentially, you try to formulate a consulting which include as many sovereign banks as possible, right? You try to encourage them to join. But in real market, it's common here somehow when a bank is in trouble, he may just try to reach out to another bank to see, okay, can you somehow help whatever and purchase some of my asset, right? This typically is called merging, okay, so whatever. So we consider here the merging is sort of, it's a different way, different from the risk consulting here. It's easy to implement. It's widely used in market, it's just. So, and then we somehow develop a sort of the model here, how to calculate the merging gains. So for example, you can choose whatever the Glassman and the Young model or the Rogers for Rod model or some other, if you really would like to elaborate a bit more that liquidation process. Okay, so depends on really a lot of choices here. But anyway, you can compute here what will be the loss before merging, and you can also calculate here the merging the loss after merging. And then particularly we consider a case where the social planner are interested to rescue all the banks. So essentially say, although the social planner is interested to see what's the merging gain, if what's the bailout cost, if he wants to ensure that all the banks become solvent after merging. Okay, so that then in this case you can really calculate here the merging gain very easily, because after merging everything is becomes solvent all the banks, right? So then it turns out a sort of a matching problem. We need to find here. Say you have a set of solvent banks and another set of default banks, and you try to find what's the best pair here, because if you merge two banks, like they can cancel the liability between them. Okay, so that's kind of the saving coming from ways. So then look at it here, and then here that we have two optimization problems here. One is actually under what condition here, so the matching with minimal bailout. Okay, another one is somehow what's the maximum gain. Okay, and these two solutions may not the same, but we did some theoretical study to identify under what conditions actually you will have both. Okay, you will have the maximum gain and also the minimal bailout. Okay, but otherwise you have to find a good trade-off between the maximum gain and the minimal bailout. So that's kind of it's a new sort of mixed integer optimization problem. Okay. So to summarize here, what we have discussed today is the basic cleaning agent model and some of its variants, and we also talk about here sort of the vulnerability and the resilience analysis in financial networks, and we also talk about quite a few risk control and mitigation strategies here, some of this optimization theory and also techniques here in this area. There are a lot of things going on here. That's really, as John mentioned here, there's a vast literature in this area. So there's things, for example, here the probabilistic modeling and the risk analysis here. We really, because our expertise, both John and myself, are really in operation research. That's why we don't talk about that. Okay, there's a lot of work going on in that direction. So if you are interested, you can just find a lot of even books, that cover books and many papers. Okay, but also we didn't discuss what's the source of risk. So here, one of the main reasons is actually the subprime mortgage. Okay, that's the sort of is criticized as the main reason for the financial crisis here. So if you look at it here, then possibly you have to use another model to analyze the risk from the market shock. Okay, you have the holding for some asset here, toxic asset outside the network, and think about it, the shock coming from some of this toxic asset here, and how you can assess that the contagious risk. So something we haven't talked about here, and also knows in the literature, but we do plan to do some work in this direction here. There is also sort of the party credit risk here, and it has to do with some insurance policy here. Say if you have some of this toxic asset, okay, and then you can purchase some the options here to counter that risk here. Some strategy here. I think there are some works in this direction. We haven't talked about that one. There's also here consider the multi-period problem where you use stochastic and kind of thing, and also the graphical approach here using consider say the network is random or certain structure here. It's also even there's a book, okay, published by Tom Hart, I think written by Tom Hart from McMaster University, and I think published last year possibly. They where actually they just using graph theory to study here what's the contingency in the financial network. A lot of works in that area. So next is just some. I think it's kind of some future research topics here in this area. I think it's because I'm mainly interested in its optimization guys setting here, and also there's some research work should be done here from the optimization perspective. In this case, really sort of non-convex kind of mixed integer here, and so far we can only prove that the solution is locally optimal, but we really cannot guarantee the global optimality here. And also there's sort of other approach, like I say, robust optimization to handle the uncertainty here. So there's a possibility really comparing this our approach with the robust optimization approach. Okay, and also for mixed integer programming here, I really don't know how far we can go. We have a very cute method for this spatial mixed integer programming, but my colleagues are working hard. I try to extend to generic integer linear optimization. But hopefully next year I will have more to say in this direction here. From a financial aspect here, then what we have observed here is even we do have quite a few different models to quantify the loss in the liquidation process. But the liquidation is just it's some subject I worked a few years ago. Okay, we had a couple papers, but in the liquidation actually that loss in most cases highly nonlinear. Okay, and unfortunately in this risk analysis, most work just assume it's linear to simplify the analysis. Okay, so I think that some work should be done to really take into account that the highly nonlinearity there. Okay. And also consider here it's a multi-period here, and the dynamics, the network dynamics, because the structure may change. As said here, like the asset for Lehman Brothers, but it's a significant change over time. So how can you incorporate that this the loss as time goes, that dynamic into your analysis? Okay. And also the mitigation strategy here without or with minimal government intervention. That's something. That's why we just made this start working in this direction. They're using this merging or some others market operations to mitigate the risk and to see. But then there's a downside in this. Okay, and some of our colleagues already started criticizing our idea. Say, no, if you do this merging, then you end up too big to fail. That's the argument. So we got to find here what's really a good trade-off. In one side you don't want the government to step in too much. On the other hand, you do need some help from them. So that thing. But also there's sort of after financial crisis here, there's new financial regulations. Okay, and one thing actually I would like to mention is actually the dead weight loss in the Glassman-Young model. That model, what we found, it's pretty much like the leverage ratio imposed the Basel III committee here, and right now before that it's 2%. So after the financial crisis here and Basel III committee, they imposed that to be, I think, to be 5%. In US here, they raised that to 6%. Okay, so that's also has to do something with John did in his study there. So But that means somehow the liquidation cost here is really not the liquidation loss. It's not a loss in the liquidation process, but more or less just some new financial regulation here. So the issue here is really how we can really take into account and combine both. Okay, so you have this new regulation here, like in United States here right now, they identified 8, what is it called, systemically important banks. They impose for these important banks, you do have to have 6 to 8% the leverage ratio. They raise that. Before that it's only 2%. Okay, so right now it's up to 6 or 8%. And John had a very interesting study say here, if you raise this, that doesn't make the network more stable or more reliable. So that's the downside. Okay, we got to look at it here. I think there's a lot of issue, and we definitely look forward to that, and also some collaborations from experts in finance and or optimization. Yeah, that's all for our presentation. So. Oh, that's yes. That's part is just for convenience for theoretical analysis. Okay, and asset value they will be negative in reality. But if you take into account the market shock, that means because here in this the basic Eisenberger model, we think the asset is something only consider here, the liquid asset here. That means you can liquid immediately, just more or less like the cash. Okay, so in that aspect, it's possible if you have a very large negative shock, then your overall position become negative. Yeah, that's kind of thing. But more I think is simply based on convenience for theoretical analysis. Is not a realistic assumption because the asset never be negative. Yeah.
I'm interested in empirical work. So I've seen some stuff, particularly with European central banks. And if you're inside a European central bank, then they give you access to anonymized activity data. But how much of the work that you've seen in preparing for the tutorial in your own work was able to use empirical data of that kind?
It's a very good question. First of all, yes, there is actually we do have some data. It's one from like here in this work. Okay, Marquille, Carrier, and Aein, and then it's still the data set. It's from the whatever EAB sort of committee here. There is a committee in Europe considering how to mitigate the risk in financial network. So they have some data available, and just still very limited information, which consists like 23 or something major banks in Europe here. And then they have some scenario that's still generated by the committee. So what we have to do here, for example, in our study here, because like when we consider here the merging here, so, that's one thing part here we really don't have a clear idea about say the merging cost. Some of them we have is using a random method here. Assuming say you have a fixed portion here proportional to what's the asset of these two merging banks, and then adding some randomness on it. So that's a way, because our colleague Michael tried to talk to some of these bankers, and he has attended 2 workshops organized in Cambridge University, and actually the first paper that he submitted, right, and that's and he asked them, how can you estimate this the merging cost? The answer is no one knows. That's a reality. It's really very hard to get the real data from financial market. That's the issue here. Why Eisenberger actually he mentioned that in his survey paper in 2013. It's in the handbook for systemic risk analysis, also published by Cambridge Press. They said here it seems to be a big issue here. The main concern is really no one knows what the data. I mean, actually, I have also a very interesting story to share with you. It's once we got one seminal speaker in our department who is an IBM fellow who did his PhD at the UH. So he's right now actually the manager of the machine learning group in IBM. So after the financial crisis, actually, the Federal Reserve, the office in New York, actually contracted the machine learning group in IBM to help them to find what's the liability metrics. So what's happening here? They have the SEC office. They have the stress test, right? So ask all the banks to submit their seasonal reports to the SEC office in New York, and then say give all this report. Each bank has a book with over 500 pages. And then the machine learning group will work a few months, try to figure out what's the liability metrics. And then the fellow told us in his seminar, he said, man, after a few months, what we conclude, say, we saw we are really some of the smartest person in the world because artificial intelligence, deep learning, all kind of stuff. They say, however, at the end of the day, what they found, there's no way to find what are the values of this, the element in the liability matrix. Why? They say, people in Wall Street, they're smarter than us. If they want to hide something, no, we're not. It's just like the game, like the others play with your kids, hide and see. We are just the kids compared with them. There's no way you can beat them, So in Wall Street, these people are too smart because the things they don't want to tell you this. And so they try their best to hide this, without to violate the law, okay, also the federal regulation. But it's very hard. They tried all kind of ways. They still, and then they use some some also machine learning methods to figure out what's the most important banks, whatever. They did some other study, that's what happened, And unfortunately, we are working hard. That's why actually Eisenberger right now he's moving to Australia, working there in the national bank and to sort of manage the risk for the national bank of Australia.